This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
When to sell, that's what many investors did today, and with stock market gains of 25% this year, more of you may be wondering, how do I know when and what to dump from my portfolio?
Another mortgage mess. Foreclosures are falling, but just as things are looking up, there may be another housing crisis right around the corner.
And phone calls on flights. The FCC will now consider rules to end a ban on in-flight telephone calls. The chairman says the move will keep pace with technology. But will flyers think otherwise? All that and more tonight on Nightly Business Report for Thursday, December 12th.
Good evening, everyone. No signs of a Santa Claus rally coming to Wall Street. Stocks sold off again today, led by another triple-digit decline in the Dow. This comes despite solid retail sales in November and as the House votes tonight on a bipartisan federal budget deal. Many Wall Streeters fear that signs of a stronger economy, along with stability in Washington, could prompt the Federal Reserve to start winding down its stimulus plans this month. Here's how the markets closed the day. The Dow fell 104 points. The NASDAQ was down 5, but closed below the 4,000 level, and the S&P lost 6 points. The price of gold also got hammered, falling $32 an ounce, its biggest two-day decline in 2 months.
Well, there's been some anxiety in the market the past few days, and it's often been explained that people are taking profits. So you're probably wondering whether you should be making changes to your portfolio soon. Joining us now to discuss the things you should consider before doing so is Jim Awad. He's chairman at Plimsoll Mark Capital. Jim, always great to see you.
Thank you.
You know, I want you to take us through the thought process of how I look at my portfolio and decide what, if anything, I want to sell because I've got a nice gain in it. How do I do it?
Okay, well, the first thing you have to look at is your asset allocation. In theory, hopefully, you've sat down with a financial advisor or thought through a process where you want X% in stocks and X% in fixed income. And if that's the case, because stocks are up this year and bonds are down, you probably have a higher percentage in stocks than what you started the year with and what you think your asset allocation is. So then you have to ask yourself, do I want to ride with this? Am I willing to have the overexposure to stocks and underweight to fixed income, or do I want to rebalance and sell some stocks and buy some bonds to get myself back to where my long-term plan is and where I was in the beginning of the year?
Jim, let's take it a little bit more specific, because a lot of people get very emotional about a lot of their investments, especially if they've done well. And this has been a year where you have a lot of gains. And so let's take some examples. Let's say someone came to you and say, you know, I own Netflix. Here's a stock that's been up 300%. Or Yahoo, it's doubled. Let's take Best Buy, up 240%. Let's just say you have these stocks. What do you do?
Okay, well, let's talk generically and then answer specifically with those stocks. Generically, you have to ask yourself, if I didn't own this stock today, would I buy it? Put another way is to ask yourself is, are the fundamentals what I thought they were when I bought the stock? Is the valuation as attractive as it was when I bought the stock? If your answer to any of those questions is no, then you have to sell some of the stock. If your answer is yes, then you're inclined to keep it unless you want, from a portfolio point of view, to diminish the chances of any one particular stock dominating your portfolio. In the case of the ones that you mentioned, you know, Netflix is it's a great conceptual growth story and a growth story, but in terms of valuation, there is no way to get your arms around it. So you probably should take a little bit of profit. In the case of Best Buy, what's attractive there is that they are selling some of the most exciting products in the marketplace with the Android and the Apple, et cetera. But on the other hand, it is a retailer, and retailing is not such a great business long term, and you're subject to tremendous competitive pressures and to the popularity of the products that you're selling. So again, you'd probably want to sell some. So you go from the portfolio question to the question of how much you want any individual stock to dominate your portfolio, and finally to the individual stock selection process. But I would be uncomfortable if any stock were more than 10% of my portfolio.
So look at individual shares to see how much of your portfolio they make up. And as you said, let's say if I've gotten to that point where I sit there and I go, my equity portion of my portfolio is now expanded to 70% from a typical 60%, and I want to scale it back. I look at those stocks or mutual funds and say, would I buy it again today? That's the fundamental question. At today's prices, at today's values. And if the answer is no, that's on your short list to kick out, right?
Absolutely. And then you want to sell some of those, or maybe even all, depending on how strong your negative answer is, as a way to get your portfolio back into balance in terms of stocks.
Do you sell it all,
bonds.
or do you sell a little piece of it if you still kind of think, hey, maybe there's a little more in Netflix?
Well, I wouldn't try to short. I'd really stick with the discipline, Tyler.
Mm-hmm.
Would I buy it again today? And if the answer is no, I wouldn't try to squeeze a little bit more out of it. Okay. I would go ahead and be disciplined and sell.
Jim, real quickly, we just have a few seconds left.
Yeah.
What do you do with your losers in your portfolio? Same thinking?
Yeah, same thing. Would I buy it today at this valuation? If the news has gotten worse in the company over the last year, then it's down for a reason. You probably want to take the loss. On the other hand, if the news is as good, if the fundamentals are as good as when you bought it and the stock is down, you may actually want to buy a little bit more.
Jim, very helpful. Thanks very much.
Pleasure.
Jim Awad, Chairman at Plimsoll Mark Capital.
Turning now to healthcare, another setback for the Affordable Care Act because of all the technical issues with the healthcare.gov website. The Obama administration is extending its December 15th enrollment deadline to obtain insurance by the beginning of the new year to now December 23rd. It's also asking private insurers to accept payment on new plans until midnight on December 31st, and says it may consider moving the enrollment deadline again.
A good sign ahead of the holiday shopping season, or right in the middle of it, frankly. A sizable boost in retail sales last month. U.S. consumers bought a lot more new cars, furniture, electronics, building materials in the month of November. Overall sales were up 0.7%, and that is the sharpest increase since June.
Along with stronger retail sales in November, there was more good news in the housing recovery. Total foreclosure activity saw its largest monthly drop in 3 years last month. Rising home prices have been a huge help, but rising mortgage rates have not. And that has some concern that the healing might slow down in 2014. Diana Olick has more.
The signs are good, fewer of these signs. That's because more troubled borrowers are finally finding a way out.
Because things in the economy have gotten better. The house prices, the employment, even the interest rates, although ticking up, are still very low relative to historical standards.
Foreclosure activity overall fell 15% in November from October. That's the steepest drop since 2010, when the robo-signing scandal brought most foreclosures to a halt temporarily. Newly started foreclosures also fell to the lowest level since 2005. While the nationwide averages are positive, some states, like Maryland, are just now ramping up the cleaning up due to big legal and judicial delays in the foreclosure process.
The story goes back really to 2010. In the summer of 2010, Maryland adopted a new foreclosure law which required mediation.
Attorney Jeffrey Fisher is in the middle of Maryland's mess.
The servicers have finally sort of figured out, through whatever different path they went through, they have finally figured out how to move forward in Maryland. And so what you're seeing now is an effort to sort of chop into that backlog.
New foreclosures in Maryland are up 74% from a year ago, and the picture isn't much better in much of the Northeast, where judges had slowed the process but are now plowing through past cases. While the foreclosure problem becomes more local, another mortgage mess is set to strike nationally. Second mortgages, specifically home equity lines of credit, or HELOCs, where so many folks were using their homes as ATMs, are starting to go bad fast.
A lot of those have what's called an end of draw period, where you can no longer draw money out of it, and instead you actually have to pay the money back.
Those periods are usually 10 years, and nearly half of all HELOCs were taken out between 2004 and 2006. For those that have already reached payback time, delinquencies are up 11% year to date. Another ticking time bomb in the mortgage market, just as things were starting to look up. For Nightly Business Report, I'm Diana Olick in Washington.
And to read more about borrowers' struggle to pay off home equity loans, go to our website, nbr.com.
J.P. Morgan Chase is nearing a $2 billion settlement with the Justice Department and regulators to end a criminal probe for allegedly turning a blind eye to Bernie Madoff's massive Ponzi scheme. and for failing to warn investors about obvious signs of fraud. Scott Cohn joins us now with more on the status of the settlement talks. Scott, what do we know right now?
Well, we know that there is a push to get this done by the end of the year. We're not sure who's pushing harder, the Justice Department or the bank. As you said, $2 billion. It would be about $1 billion or so to the Justice Department and another $1 billion or so to regulators, probably including the controller of the currency in the Treasury Department. And there's also likely to be what's known as a deferred prosecution agreement, which is a pretty stiff penalty for what we used to call a money center bank. They would basically have to agree to reforms with the Justice Department continuing to hold the threat of prosecution over their heads if they don't comply.
You know, Scott, JP Morgan has been writing a lot of big checks recently. What exactly did they do wrong this time?
Well, we should
allegedly.
We should point out it's allegedly, and up till now, the bank has said that they acted in good faith. But a lot of this goes back about 3 years, almost exactly 3 years, to a lawsuit that the bankruptcy trustee, Irving Picard, filed. These same allegations that J.P. Morgan was Bernie Madoff's primary banker. All of the money in the Ponzi scheme flowed through one account, was known as the 703 account, and that the bank had to know just based on that. Not only that, they were actually selling these structured products, funds that were based on Madoff's returns. So the thinking is they had to know where these returns were coming from and whether, in fact, they were real.
Now, where you mentioned a little bit about where the $2 billion, if it is does turn out to be $2 billion, will go between the controller of the currency and the Justice Department. Will victims get any of this money?
Well, they'll get at least some of it. The Justice Department has a fund that was set up just last month that would pay to the victims. And it's not just any victims. It's victims that invested in Madoff indirectly through feeder funds. We reported on this last night how people that didn't invest directly are not entitled to recoveries from the trustee from
Picard.
So they have to wait. This would give them perhaps a little bit of a lifeline.
All right, Scott, thank you very much. Scott Cohn reporting.
Well, this latest J.P. Morgan settlement comes at the 5-year anniversary of Madoff's arrest. Mention the name Bernie Madoff, and it became synonymous with greed and all that was wrong in the financial crisis. Now, 5 years later, is the financial crisis over? Here to answer that question, Jesse Eisinger, a senior reporter for ProPublica and a columnist for the New York Times. He won a Pulitzer Prize for his investigative reporting of the financial crisis. Jesse, nice to have you on the program.
Hi, thanks for having me.
Well, let me just begin by asking you, the prevailing view seems to be that banks are in much better shape. They've stabilized, that the financial crisis is over from that perspective. The government is out of the bailout business. We just reported this week that it no longer owns any part of General Motors. We just reported that housing is doing a lot better. So what is your thought on all this? Is the financial crisis really over?
Sure, happy days are here again. I do think the financial crisis is over. The question is whether we've done enough to prevent the next financial crisis. And since a crisis is inevitable, the question is, will it be huge and blow up the world economy? And I think the answer is no, we haven't done enough.
Have we solved the problem of too big to fail, a bank that is too systemically important to let it go?
Jacob Lew, the Treasury Secretary, said this last week in a speech that we could say with a straight face that we have solved too big to fail. I think that's, I don't think anybody on Wall Street or anybody observing this could keep a straight face.
Why do you say that?
There's no way that we have solved this problem. First of all, the banks are bigger than they were going into the crisis. The second thing is that no one believes credibly that the government would have the will to resolve a big bank if it was on the brink of failure and impose costs to shareholders possibly, but bondholders no. Right. I don't think anybody believes creditors would not be protected. And the second thing is that the question is what happens on day two. If some crisis hits that would hit J.P. Morgan, it would also hit Bank of America or Citigroup, and then they would step in to save those entities or that market.
There have been so many regulations, Dodd-Frank and all of that, and now recently the Volcker rule that have been slapped on with these banks to make them safer and stronger in the case of a financial crisis. You said everything is not done yet. What else do you think needs to be fixed? I mean, what is the most important thing that yet should be done?
Yeah, I think they've incrementally done good things with derivatives. They've done good things with the Volcker Rule. The Volcker Rule is a lot stronger than when it first came on the scene, when it was first proposed. I think what they haven't done is solve too big to fail. They haven't gotten leverage requirements right. We don't have adequate capital requirements for the largest banks, and we don't have any sort of credible resolution authority. And that's the big central question. So, and the final issue is that we don't have adequate enforcement. We have criminal violations at J.P. Morgan, allegedly, but they're about to admit it, for the Madoff scandal, and yet not a single person seems to have committed a crime. When banks admit LIBOR violations or they admit manipulating other markets, not a single person seems to have committed any crime in any of these cases. Not a single person committed a crime in the financial crisis. I'm puzzled how that could possibly be. And without that kind of accountability, I don't think you get change.
All right. Really interesting conversation. Jesse Essinger, thank you so much from ProPublica.
Thank you for having me.
And the New York Times.
And still ahead, it was a big day for IPOs. It's been a big year. But what's in store for 2014, especially on internet offerings? Hovnanian delivered more homes and higher earnings, and that is where we begin tonight's market focus. The home builder's fourth quarter results blew away Wall Street's estimates, another sign that the housing market is recovering. The company also predicts more profitability in the new year, and that sent shares higher, up almost 6% to $5.28. Lululemon reported higher than expected earnings today, but the company's outlook put a damper on its results. The yoga apparel maker, which has been struggling since its see-through pants debacle in March, one of the great business stories of the year, lowered its sales forecast and said store traffic has slowed. The news was very disappointing to investors. Shares plunging. They were off more than 11.5% to 60.39. Ciena reported a quarter with higher costs and weaker than expected profits, and that sent the network equipment maker stock into the minus column. The company blamed the miss on its telecom customers like AT&T and Verizon, who have been holding back on spending. Shares off about 7%, $21.31 the close there. Aetna said it will not be reinstating plans it canceled that didn't meet Affordable Care Act standards. The insurer CEO said it doesn't have enough time to go through the regulatory processes to extend or renew those canceled health insurance plans. Last month, President Obama said insurers could extend plans that didn't comply with the ACA temporarily after hundreds of thousands of Americans found out that they could not hold on to their existing plans. Aetna off almost 2%, 65.14 the close.
Cisco delivered more bad news to investors. The company cut its earnings and revenue targets because of trouble in emerging markets, tightened consumer spending, and its lagging network equipment business. The announcement was a more detailed report of a warning that Cisco issued in early November. Shares fell more than 1.5% to $20.51. Buffalo Wild Wings waged a soda war today. The chain said starting next year, it'll switch from serving Coke to Pepsi in its restaurants. It also plans to tap into Pepsi's snack business and use Doritos in its new menu items. Coca-Cola still dominates the fountain business in the U.S. with an estimated market share of 70%. All three stocks were down on the news. Pepsi fell more than 1.5% to $81.28. Coke dropped 2% to $39.21, and shares of Buffalo Wild Wings off more than 1% to $141.77. Aramark had a successful market debut today. The food services company sells beer at sporting events, including teams like the Chicago Bears. Aramark raised more than $700 million from the IPO. Here's what the CEO said about plans for that money.
Originally, we'll pay down debt. Over time, our uses of cash will really be to invest in the business. We think it helps our competitiveness. We'll continue to return cash to shareholders by paying a dividend and over time looking to buy back stock.
The stock today rose 13.5% to $22.70. And Hilton returned to the market today in the biggest hotel IPO in history. The sale of its shares raised more than $2.3 billion. The CEO of the world's largest hotel operator says the company's global outreach is what it sets it apart.
What differentiates us is that there is a significant value opportunity associated with the growth, particularly internationally, but the growth generally in our management and franchise business, where we have nearly 190,000 rooms in our pipeline, nearly 100,000 rooms under construction. And of those rooms under construction, almost 80% of them are outside the U.S. and all the parts of the world that are growing so fast.
And shares were growing fast today. They jumped 7.5% to $21.50.
Well, Hilton and Aramark may be two of the final IPOs of this year, but 2014 is expected to be a huge year for IPOs in the tech sector, internet companies in particular. So what's driving the push in tech IPOs, and what should investors look for? Julia Borston has the story.
After Twitter's big public debut, investors should get ready for a slew of internet IPOs, from the likes of Airbnb to Guild Group, Pinterest to Uber. Research firm CB Insights says the number of internet companies in the tech IPO pipeline is up 39% from last year to 320. 25 of those internet companies are valued at $1 billion or more. Social tools will be more important than ever, but don't expect companies competing directly with Facebook and Twitter to go public.
Building that type of two-sided network that a social network requires is a very difficult thing to do, and most folks that try will not be able to do it. But if we can leverage kind of those social technologies to grow, and sell another product or service, right, that's sort of the way to go. So I think, social has become a layer that, everybody's sort of tapping into. And so we're seeing that more and more.
Venture capital has been abundant, so companies that want to delay the regulatory oversight that comes with being a public company have been able to find funding elsewhere. But a number of big internet names have significant revenue and have been around for so long that investors and employees are eager to cash out. So who will cash in? Of the VC firms, Kleiner Perkins has backed the most pre-IPO companies, including mobile payment startup Square. And of the corporate venture funds, Intel tops the list, with investments including cloud storage and sharing service Box. But which companies actually make it to the New York Stock Exchange and NASDAQ will depend not just on their revenue and growth, but also on the markets.
If the markets in general turn, then the window that these companies may see that they have closes. And so I think that's probably the biggest thing. I think the other thing is that there's lots of money, private money, for these companies, right? And so the need to go public has also diminished a bit. And so I think companies are choosing to wait, choosing to get the timing right.
But for now, with Twitter shares at an all-time high, up more than 110% from its IPO price, the market is looking ripe for the crowded pipeline. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Coming up on Nightly Business Report, regulators are considering rules to let travelers talk on their cell phones on flights. But is that what the flying public wants?
Mexico approved an historic energy bill today. The legislation ends a 75-year monopoly by the country's state-run oil industry and opens the way for private and foreign investments to explore and drill for oil and natural gas. The vote was contentious and emotional, but proponents say the bill will boost Mexico's oil production and its economy. Despite the protests, Mexico's president expects to sign the landmark legislation into law in February.
If you think you've been paying too much for plane tickets, you might be right. An airline trade group reports that the global airline industry will make nearly $13 billion in profits this year, with more people flying and lower costs for jet fuel. Next year, the industry is predicting profits of around $20 billion.
Meantime, Susie, the FCC voted to consider lifting its 22-year ban on the use of cell phones during flights. The chairman said new technology is making the reason for the ban obsolete. It was a split vote. 2 Republican commissioners dissented, but all of the commissioners expressed reservations about allowing phone calls during flights.
Nothing will be different on your flight tomorrow. We're seeking comments on a proposal. We'll go to a vote. All of those in favor say aye. Aye. Opposed?
Name. No.
The ayes have it.
Well, a new poll from the Associated Press finds a majority of Americans who fly regularly are against allowing those in-flight calls. We spoke with some people about how they feel about the possibility of cell phone calls being allowed on flights.
Many people are very loud and obnoxious when they talk on the phone, and I don't think it's fair to everyone else sitting in a very confined area.
It interrupts the quiet of the flight.
It wouldn't bother me.
I don't want to hear everybody else's business. I don't want to hear personal stuff.
It depends on how loud they're talking. That's why it would be annoying. If it's not loud, then it's not annoying.
Very distracting if I'm trying to read.
It's for relaxing purposes, not for social networking.
You can't hear what the pilot and the stewardess, what they're trying to tell you.
And you can't sleep.
And you can't, I think it's an awful idea, but as you were pointing out, I think what will happen is that airlines that allow it will have sections of the plane where they will charge extra, where you will then be allowed to sit and use your phone.
Let's hope that they don't talk even over.
And I don't want to be in a middle seat.
No, not me either. Anyway, that's Nightly Business Report for tonight. I'm Susie Garrow. Thanks so much for being with us.
And I'm Tyler Matheson. Thanks from me as well. I'm going to leave my cell phone on the ground. Have a great evening, everybody. We'll see you tomorrow.
Nightly Business Report has been brought to you in part by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
I'm Susie Garrett with a Nightly Business Report news brief. No signs of a Santa Claus rally coming to Wall Street. Stocks sold off again today, led by another triple-digit decline in the Dow. This comes despite solid retail sales in November and as the House votes tonight on a bipartisan federal budget deal. The Dow fell 104 points. The Nasdaq was down 5, closing below the 4,000 level, and the S&P lost 6 points. Retail sales rose sharply higher in November as consumers bought more new cars, furniture, electronics, and building materials. Foreclosures fell to a 15-year low in November, down 10% from the prior month. And J.P. Morgan Chase is nearing a $2 billion settlement with the Justice Department to end a criminal probe for turning a blind eye to Bernie Madoff's massive Ponzi scheme. Be sure to tune into Nightly Business Report right here on your public television station.